The Federal Reserve raised the Fed funds rate on Wednesday by 25 basis points, as was largely expected by the markets. But are there more rate hikes to come, or is this it? Breaking down forward guidance with us and expectations for capital markets and the growth of the economy is Dave Weisberger. He is a CEO of CoinRoutes, a crypto analytics company. Prior to working in the crypto industry, Dave served in a number of senior leadership positions at major financial institutions, including Morgan Stanley, Sullivan Smith Barney, and Citigroup. Welcome back to the show, Dave. Always good to see you.
Thank you, David. It's always interesting times, although today seems a bit kind of a bit dull. Things as predicted generally don't change much in markets.
Would you want high volatility? I mean, let's be serious. Wouldn't you want a predictable economy and predictable markets, even though it's dull and boring?
Well, part of me does. As a citizen, I think that's a good thing and a good outcome. As someone who operates a trading software company, I'd say that a little volatility is probably not so bad, but obviously that's a vested interest here. But no, your point is well taken. Predictability is probably good, and it's really the black swans that we want to avoid, and then things on the upside, they could be telegraphed. But yes, I do agree with you.
A number of interesting questions was brought up to Jerome Powell during the press conference. I'll start with this one.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects.
Well, it depends what you mean. Restricted enough for what? If the goal is to decrease inflationary expectations, which is, I think, his goal, then you have to actually look at what's happening. Commodity prices, PPI prices, input prices to inflation are all falling off a cliff. If the goal is to cut the market to bring down the wealth effect, then he's obviously failing in that goal because he hasn't so far knocked down the market. And there are people who quite cynically believe that is what he's trying to do. I personally believe what he's trying to do is what he has said he's been trying to do. And he's actually done an incredible job of it. He's trying to manage inflationary expectations, that there's less wage push inflation. He's trying to manage a yield curve that stays inverted because he wants the government to be able to borrow without it busting the budget. Keep in mind, if we had long rates at a normal 2% upslope from here, that would be more or less a doubling of our debt service payments, which would effectively squeeze out all discretionary payments. And it would mean the federal government literally couldn't spend a dime without going into deficit. That is a serious problem. And that is one that he, I think, is quite focused on, has been focused on since the beginning. And I actually give him credit for engineering the negative yield curve without it directly impacting employment or being a recession, whereas a lot of people think that it's just kind of random. I don't believe in coincidence or random, David. It just never have.
So what's his actual intention? And I'll give you two sides of this argument. One is that he wants to engineer a hard landing. He obviously does not want to admit it because this particular camp thinks that the only way to bring down inflation to disinflationary levels or outright deflation is to create a hard landing recession scenario. Now, another camp thinks that you don't need a recession to get inflation. In fact, we're not technically in a recession now, and the CPI has been coming down. Which camp are you in?
Definitely the latter. I think there are many cross currents here, though. And look, when you look at the economy, there are many variables. This is not a function that you could draw on a single chart, right? So think about what caused the great inflation. And we could debate what the percentages were, and lots of people can debate it, but there were a few crosscurrents that caused the massive bump in inflation. There are three that people talk about. I think all were relevant. Number one, you pumped an enormous amount of money into the economy. I mean, half of all dollars created, all within a very short period of time to, quote, combat the pandemic. I learned, at the Milton Friedman School, basically, although I went to Northwestern, I always believed in the Chicago School of Economics better, and you and I have talked about that before. The fact is, if you double the amount of dollars, don't expect the price of goods in dollars to do anything but go up. The second thing that happened simultaneously were constrained supply. We had the pandemic, cut supply lines all around the world. Lots and lots of pressure on supplies, commodities, many things became more dear, more expensive to ship, more expensive to produce. Lots of things didn't get produced. So the supply side was there. The demand stayed where it was. Inflation goes higher. Very basic economics 101. The third thing that happened, they did helicopter money to people. They did something that reversed a policy of 30 years. For 30 years, we had a policy where most inflation showed up in asset prices. It was targeted to show up in asset prices. And so assets are held mostly by the rich, and those assets actually contribute to some consumer disinflation. I'll get to that in a heartbeat, but it went to asset prices. Here, they gave $5,000, $6,000 to families who could spend. And I think I talked about it the last time I was on, my trip from New York when I was emigrating to Florida. And all the amounts at all the hotels along the way were full with people spending their stimulus checks, trying to get the heck out. South Beach was overrun by people who were spending money that they were just kind of given. It's not like they were using it for what the intention was. They used it for discretionary spending. Well, you put that much money in the hands of discretionary spending in a supply-constrained environment, what do you expect is going to happen? Bam. Inflation goes crazy. Now, the other thing that's interesting about this, about the switch from targeting asset prices to targeting, to direct family subsidies, is asset prices. When the cost of money is artificially cheap, one of the things that allows companies to do is to automate more, offshore more, because those fixed costs cost you less as you can borrow that money. And so you ended up with all this disinflationary pressure from outsourcing and from automating, which actually decreased consumer inflation. People could buy cheaper goods that were produced, overseas or produced by robots and or served by robots. So all those things going simultaneously. So now you're at the Federal Reserve. What do you not want to do? Well, you want to cut the consumer demand push inflation. You want to decrease inflationary expectations and therefore constrain the economy and bring, kind of normalize conditions. You want to normalize conditions, but you really don't want to do things to make it harder to invest in technologies that will improve the supply chain and actually be disinflationary. And, people like the stalwart, on the Odd Lots podcast talk about this all the time. But it's a very good point, and people don't generally look at it. I do think Powell understands all this stuff.
Chair Powell has said during the press conference that the Fed needs additional information before deciding to either hike again in September or pause. And in fact, in the latest statement, it says that the committee will continue to assess additional information and its implications for monetary policy. He's not committed to either hiking or a pause just yet. He needs to wait. What additional information does he need before making that decision, Dave?
Well, that's a great question, because the answer depends on how you answer it. My friend Mike McGlone would say that the answer should be different. They should be looking at leading indicators, not lagging indicators. But what do they actually look at? They generally look at lagging indicators. Now, what do I mean by that? Leading indicators, things like PPI, things like business confidence, business investment spending, et cetera, et cetera. Lagging indicators like CPI and the GDP price deflator, which is their favorite inflation metric, are what they actually look at, and that's wrong.
It's wrong because it's lagging. That's what you're saying.
I mean, it's like I use the expression, if you want to drive a car, you don't use the rear view mirror, you look out the front mirror. But if you're insistent on turning around and looking out the rear mirror while you're driving a car and it's a twisty, bendy road, you might drive off a cliff. And there are a lot of people out there who fear that analogy is what's going on at the Fed. Now, I don't think they're that dumb. I'm not saying that. What I am saying is, by biasing your the data that you care about to things that are clearly lagging indicators, you are likely to overshoot. And the history of the Fed, dating back as long as I've been in the business, and I hate to admit how long that is, so we'll leave that one lie, is that they have overshot in both directions. They certainly overshot on the downside when they were being accommodated for too long. We all understand that. At past recessions, they've overshot to the upside. And it's because of the generic method of looking at those what I'm going to call lagging indicators. And the reason that happens is because of the political pressure those lagging indicators create. That's my read on it anyway.
Another interesting question was brought up to him, which is that the energy prices have been coming down anyway.
Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing.
Well, first of all, as it pertains to inflation, that's nonsense, and it's nonsense for a couple of reasons. I mean, the report was just flat wrong. So the assumption in the question is wrong. Now, why am I saying the assumption in the inflection is wrong? First, there's two reasons. First, energy. I don't know where energy prices would be if the Strategic Petroleum Reserve was as full as it was at the beginning of the pandemic. And I don't think anybody does. But I think we have a pretty clear understanding that by us being willing to tap at least 50% of the SPR, that helped bring down oil prices. So we know that that's true, and that is a form of manipulation that people don't like to talk about. The second thing that is absolutely true is it's not the pandemic that was the issue, it was the response to the pandemic. So the government's shutting businesses down, causing supply things to go on, and giving stimulus checks. That causes a shift up in the demand curves. And yes, over time that could work itself out, but it takes a lot of time. And you need to look at the way monetary policy was at that time in that policy response. Part of the policy response was to make interest rates negative, real interest rates, the highest they've ever been, meaning the lowest interest rates, but having the negative number being the largest in terms of real interest rates. And then when you look at whether or not he's actually been restrictive, I mean, the reality is that today's inflation rates, Fed policy, Fed funds are well within historical norms, probably toward the more accommodative side of historical norms. It's only norms compared to the last 5 years that it looks restrictive. So it's all relative, and you need to understand that. And Powell certainly understands that. The fact of the matter is, when Volcker, and I was, had just graduated college or was just in college when Volcker was doing that, and I was studying economics. The fact of the matter is Volcker raised interest rates to double-digit percent. He raised it to 6% over the peak rate of inflation. We are not even close to over the peak rate of inflation on interest rates. And in point of fact, that's why it's been a slow measured increase. And his hope is that the rate of inflation, which is now below the Fed's funds rate by a couple percent, is more or less where it should be in terms of historical norms. So under no way you could look at policy as massively restrictive. It went from the most accommodative Fed policy in history to normal. Now, that happens to be a very high rate of increase, but that is what it did. So the assumption behind the question was wrong.
This is very interesting as well. The CME Fed Watch tool, I'm seeing updates as we speak. There is now currently a 76%, 77% now chance of no hike by September. That's what the futures market is pricing in. There is also a 67% chance of no hike by November, and by the end of the year, December, 65% chance. So there is an overwhelming probability that this will be the last one of the year, if not ever. That's interesting because the core PCE number is still at 4.6, which is double the Fed's 2% target. Is the market assuming that inflation will just fix itself at this point?
I think the market is assuming that that the data is going to show the trend in the appropriate direction. So 4.6% of the Fed rate of 5.25 is still positive real interest rates. It's been a very long time since we've had positive real interest rates of any substantial notion. If 4% becomes the new norm from 4.6, that'll be 1% positive real interest rate. If it goes to like 3.5, now all of a sudden, you're getting back towards really kind of the middle of the range where the Fed likes to be in terms of where real interest rates are. So I think the market is basically saying, listen, they're going to watch to see what these numbers are, and if they trend in the right direction, they're going to keep a steady hand on the tiller. Because remember, they can't afford to have interest rates go too high for a couple of reasons. The things that are in the economy that could break are important. The most important of which is federal budget deficits. But it's also true, we've seen how much money or how much accommodation the Fed needs to do through their extraordinary program that we talked about last time, by virtue of bond prices dropping that are held on bank balance sheets. But there's a lot of commercial real estate. There's a lot of other things in the economy that they have to be concerned about. So they don't want to break things. They're only going to continue to push higher if they believe it's necessary to quell aggregate demand and stop wage push inflation. That's really what they're concerned about. So if you see a huge round across multiple industries of labor strikes and significant increases in wages and new contracts, yeah, I think they will increase rates. If not, I think they'll probably stay where they are. Now, of course, it has to be said, these prediction markets are notoriously fickle. They're very volatile. This was, 2 days ago or yesterday, this was a 96% that this was what was going to happen. But if you go back 6 months, the probabilities were dramatically different and vacillated a lot over that time. So yes, I think people in the market say, you know what, they're going to wait and see. And those numbers basically say the market is predicting the inflation numbers to continue to look better over time, if at least be in the right trend. And there's also a camp of people who believe we're going to have a significant market correction in the fall, which would mean to the Fed, potentially job done, don't need to do anymore. Now, I'm not saying that's going to happen, but there are a lot of people who believe that.
Powell said that the policy has not been restrictive long enough to make that assessment in full, meaning that I think he's telepathing that he's going to keep rates elevated for some time more. If no more hike, at least he's not going to cut anytime soon. Let me ask you this, Dave. If that is true, that he's going to keep rates elevated, do you think the economy can withstand 5.25 for a significant amount of time?
Yeah. And the reason is because if you go back and chart the average Fed funds rate through the last 30 years and compare it, especially if you do it vis-a-vis real rates versus rate of inflation, and you look, we are not even close to what you would call long-term restrictive. So there have been plenty of long sustained economic growth periods during this time. Now, whether or not the economy will depend upon other factors which matter a great deal, things like the pace of regulation. Government regulation, if it continues at this pace, is going to choke off the economy anyway. But as we go into an election year, who knows what will happen? So there are many, many other factors that influence the economy. I would say the Fed is at best in a neutral policy position right now.
You're absolutely right that the historical long-run Fed funds rate has been around this level, if not higher. But here's a counter argument to that. I'll let you to please address this. In the past, the nominal value of debt has not been this high. I'm talking about not just federal debt, but also corporate debt and also personal consumer debt, credit cards, lines of credit, so on and so forth, mortgages as well, car loans. And so the level of debt partnered with 5.25 means the interest payments on this debt have never been higher. Consumers, corporations alike can't withstand this for much longer. How would you respond to that?
Well, it depends on the type of debt, doesn't it? I mean, I have a 3.25% mortgage on my condo. That will get sold from, well, it won't. There's no chance I would sell out of that. And that's one of the reasons the home builders have been doing so well, because the amount of available supply in homes is dramatically lower. People aren't upgrading, they're not moving, et cetera. Car loans, similar stuff. I mean, but at the same time, that car loans, people don't want to get out, have the cheaper ones. They want to keep them. The fact is that car prices got ridiculously high for used car prices in particular, and supplies got really tight in the pandemic. Now there's a ton of supply, and supply and demand tends to be a pretty big influence on inflation and prices. So it really depends on that. But the fact of the matter is, if you ask me what do I think is going to happen, I've been saying this forever. The Fed is trapped. That amount of debt means they can't be really restrictive. They have to just look like they're willing to get restrictive if that's what it takes. And so a lot of what's going on as a narrative is, let's try to get people to not have high inflationary expectations, because if they ever did get truly restrictive, if you saw the Fed move to real interest rates around historical averages, I think you're right. I think the economy would have a huge problem because of the amount of debt that's out there. I mean, when Volcker did what he did, which was 6% over the rate of inflation to 20 some odd percent or whatever it was, the total debt to GDP of the federal government alone was 34%. We're at 130 some odd percent now. So it's obviously a very different situation with very different impacts. But the Fed has to be mindful of that, which is why they're being so much more cautious as far as this rate tightening cycle goes.
I'm going to come back to your economic outlook that you gave in the beginning. So you don't think we're headed for a hard landing, at least not yet. Are you in the Mike McGlone camp? And I know you've talked with him several times. You've worked with him, and I've spoken to him a couple of times. He believes that we're going to get deflation. Is that something you share, a viewpoint?
It depends on what. If you mean on commodity prices, yes. Why? Because we get more efficient getting commodities out of the ground. Improvements in technology, which you used to measure it as productivity, but in mining, that's really impossible to do. But the fact is, certain things he doesn't necessarily believe they're deflation. He believes that they're long-term more or less where they were and are going to stay that way, because our ingenuity tends to outpace the other factors that will cause inflation. Do we see deflation in other places? Possibly. Are we headed for things that could be massively inflationary that the Fed couldn't do anything about, i.e. deglobalization? Yeah, those are serious trends, right? Globalization is a massive deflationary trend. If the United States enacts things to decrease globalization, that could be problematic there. So there's lots of cross currents on that. Where Mike and I differ, really, is that I think that we're nowhere near as restrictive as he thinks we are. And so I'm nowhere near as convinced that we are guaranteed to see a 25+% correction in risk assets this year. I think there's absolutely a possibility. I think that historically in markets like this with these sorts of extended multiples, you do see that sort of a correction at some point in the fall. It's happened many times in our lifetimes, but we will see what happens. The difference is, and this is important, I think, that the nature of the Fed put has changed. The Fed put used to be, if financial markets go down, the people believe the plunge protection team, the PPT, as it's often referred to by people in the industry, led by the Fed, would step in and stop the market downturn. I don't believe that exists anymore. I don't think the Fed cares if the market drops. I think the market has to drop a lot for the Fed to start to care. But I do think that the Fed put, as far as the integrity of the financial system, i.e. the banks and the banking system and the plumbing that is relied upon in the banking system, that Fed put is alive and well. And that's why you saw them be willing to put out $4 trillion to back up bank balance sheets. And that's why I believe that there's a commercial real estate problem. They will intervene. Now, that doesn't necessarily directly impact the stock market, but it does impact money supply and Fed policy.
You hinted at this earlier, that if the Fed were to be too restrictive, it would risk breaking certain things. Are you alluding to the commercial real estate market?
Well, commercial real estate is the most obvious, right? Because there's some secular trends, not cyclical. I do not believe that work from home at this point is cyclical. I think that the people willing to commute into the biggest cities in this country and for an hour or so a day is not coming back anytime soon. And there are a lot of companies that are trying to get their workers to come back into the office. I mean, look, my company at CoinRoutes, we all believe that we are dramatically more productive when we're in an office. But we're in Miami, where we average 20-minute or 15-minute commutes, and it's a much more congenial city. A lot of companies are going to move toward collaboration pods, but these huge office buildings, which are on the balance sheets of many firms, there's a lot of liability there. And it's generally in the regional banking system.
If you believe Jerome Powell's narrative that economic growth is still continuing and that inflation is eventually going to come back down, and perhaps the markets are thinking that there's going to be no more rate hikes at the end of the year, is this not just the perfect environment to buy more risk assets then?
I actually differentiate among risk assets. I think that at a certain point, while I'm not a pure Graham and Dodd guy, because obviously technicals matter, sentiment matters, crowded trade matters, lots of the factors and impact assets. I think that there is a point of fundamental valuations that do matter, particularly if you're talking about a year out time frame, which is sort of what we're talking about, or at least 6-month time frame. So it depends on the risk assets. If I'm buying a risk asset that's a meme or a story stock, and there is some tightening and we do have a correction, those are the things that are going to correct by far the most. If I'm buying something which looks cheap on fundamental metrics, well, yeah, then I'm a big believer in that for a bunch of reasons. I mean, my favorite investment right now, I mean, I know it's boring and I'm a crypto guy and you're going to shoot me for it, is Bitcoin. I think every single fundamental metric of the Bitcoin network are approaching all-time highs except price. I mean, number of addresses, hash rates, et cetera, they're all at all-time highs. And if you look at the narrative around Bitcoin, I think that is one that could easily de-link to the upside. If you talk about a stock like NVIDIA, where it is priced to perfection, and sure, there's a great AI narrative there, but the fact of the matter is they're not the only chip maker, and AI is a lot more hype than reality in many applications. Some applications like ChatGPT and the ones like that are huge, right? I mean, every one of the search engines are going to have AI in their search engine, but is it really primed to replace everything that people think it's going to replace now? Or is it like every other tech cycle? An initial boom that gets everybody excited, a somewhat, whether crash or at least cessation of that, time for it to catch up, and then a more slow, steady growth or as the technology matures. That's kind of where I see that. But there's a lot of other things in the stock market that have nothing to do with AI and have nothing to do with stories. So it really depends on the fundamentals and what you look at. I think that it is entirely possible that there are many things that are stretched valuations, and they may not do as well as the ones with less stretched valuations. I know I start to sound like Cliff Asness here, we're talking about value versus growth, but in a difficult, more normal environment, I would think that you would see some outperformance on that too.
So suppose this AI narrative were to stay in that it's not just a fad, it's a sustained development that will evolve and take place over time. What supporting industries are likely to benefit from this AI boom?
Well, the most important industries that will benefit from the AI boom are both supply and demand side. So the supply side are data companies, people who actually have access to large language models. Now, it's not public anymore, and who knows whether he'll be able to pull it off. But if Elon's vision for X turns out to be true, and that becomes undervalued, and suppliers and lots of companies which are collecting data from that, providing to it and using it, could very well get a boom for it. And that is true for all types of social media that might very well get involved, but it's fraught with danger because things can change. On the other side of the equation, you have companies that can get more efficient. There are a lot of industries. So things like there's a technology company, technology called Zendesk. That's just one that helps people more efficiently handle customer service. So the first wave of customer service efficiency was gained by outsourcing. The next wave will be gained by AI. Every time those things happen, companies that require large-scale customer service gain in value because they get to lower their costs and provide a better experience to their customers. AI is going to sweep that industry and all of those industries. And so look for companies that have very expensive customer service that will probably be able to get cheaper. That's why I said I don't want to comment on specific items of research, because it gets very company specific at that point.
Right. Now tell us about the analytics program or dashboard from CoinRoutes and some of the narratives that the data is providing you or telling right now in terms of sentiment, capital flows, so on and so forth. Yeah.
I mean, we're seeing, broad-based, we're seeing a couple things. So the two things I would talk about in our data that's most interesting is, first, Bitcoin at this point even though we're a large institutional platform. Bitcoin makes up somewhere in the 30% range, 30 to 35% of all of our volume flows, despite being about 50% of the market, meaning that there's less trading because Bitcoin's implied volatility has dropped. Bitcoin has gotten more stable. The speculation has calmed down dramatically, so it's mostly long-term buyers. So that's something that we see in the data that's completely also verified or corroborated by the price data and the action. The other thing that we saw in the data I was telling you about before we went on air, I saw this morning, is my friend Larry Tabb published something from BTCA, from Bloomberg, which showed the cost of the United States versus other equity markets for trading everything from less than 5% ADV to large institutional orders. I actually did a quick compare of that over the last quarter to CoinRoutes clients, and it's fascinating. U.S. equities for less than 5% ADV but institutional sized orders showed over 11 basis points of cost from the midpoint at the time the order was given. In crypto, all crypto, not just Bitcoin, where it's even much smaller, CoinRoutes clients were somewhere around 7.5 to 7.6%, or 7.6 basis points away. So in actual fact, our clients are trading crypto cheaper in terms of arrival price, or TCA, than they can trade U.S. equities. Now, U.S. equities is widely maintained as the most efficient market in the on the planet. I personally believe that it's overregulated in the sense of too prescriptive rules governing tick sizes and other things like that. The crypto markets, as wild as people might want to say them, if you use the right technology, can clearly bring that market to be as efficient as equity markets. And in fact, we're as efficient as some of the other countries which got to that level as well. So I thought that was fascinating, and I will be writing about that.
Excellent. Well, where can we learn more about the analytics from CoinRoutes?
Well, we'll be publishing more on blog.coinroutes.com. Coinroutes.com is our website. Follow me on @DaveWeisberger1 at Twitter, or follow @CoinRoutes on Twitter and LinkedIn, and you'll see all of this data as we publish it.
Have you ever considered making like a terminal? Is that something that people can, look forward to one day?
We've talked about it. The truth is we're an institutional platform right now. We believe active traders will ultimately be where we will go. But there is a difference between being a data company and being a trading company. And there are other companies in the crypto world that are more data companies, and we're more of a trade software company, because customers tend to want to pay for one or the other and not both. And it's the same reason that that Bloomberg sold Tradebook, right? Because they didn't want to be a trading company and a terminal company. And so we've kind of made the exact opposite choice to them, mostly because we don't have almost 400,000 terminals being paid for like $2,000 a month out there like they do.
Sure. Yeah. All right. Well, that's interesting. I mean, you have a bank. I'll just close off on this. You have a banking background. Are you expecting banks to eventually adopt software like CoinRoutes analytics en masse? Like everybody to use a Bloomberg terminal, everybody will use CoinRoutes?
I don't know about everybody. I think that algorithmic providers like us, in the early days, Credit Suisse and ITG were the two pioneers in that, and they got to well into the high double digits of market share. And I think that we have a shot at doing that. The fact is, the most important question going on, because there's this huge narrative. Today was a seminal day, actually, in crypto, because the House Financial Services Committee and Agriculture Committees are marking up an actual market structure bill to bring red legislation and regulation into the 21st century. And it's still opposed by people who just believe that either they believe crypto is just wrong because they just don't understand it, or they have vested interest to protect entrenched players. But either way, as we modernize our financial system, it will go from analog to digital. And when that happens, software like my company's will be part of the toolkit that all the major players will adopt or build themselves. I mean, I don't have hubris about this. I don't know how much will be what we do, my competitors will do, or they will do. But what I know for certain is that the digital asset revolution is still in its extremely early stages, arguably infancy. I'm not even sure we're into the first inning yet. And it will be what takes over finance. So to me, that's really the meta trend to care about.
Oh, excellent. We'll keep tabs on that. Thank you very much for spending the time today with us. Appreciate it.
Thank you for having me, David. Always a pleasure.
Always a pleasure to host you, and thank you for watching. To the audience, don't forget to subscribe.